let's start our class on depository institutions like bank. So before we move on, let me talk about the group activity number 1. So now you may have some idea that how we are going to proceed during the semester, and because you are participating in the game and your role will be given as a financial institution or the financial consumer, you should wisely choose your choices, and you need to set up your strategies based on the expectations what others are going to do, and then you will be able to understand the circumstances in the financial markets and what financial institutions do in reality. And here are some of the comments from your report after the group activity. So I have chosen some of the comments because I wanted to share that they are insights. First, businesses, individuals, and banks interact with one another through several steps. And second, in reality, we often forget that banks are also profit maximizing entities and they may fail. However, actually, they can go bankruptcy. And third, you have to manage your risk, especially when you do not have sufficient information. And therefore, it is essential for the market participants to get the information and to be provided. And finally, it is not easy for a company to persuade a bank that this company can fully repay the loan. So this is all related to the credit risk that the usual companies need to take care of, and also the banks should take care of their credit risk. And in this class, in chapter 2, we are going to learn about the depository institutions. So we are going to understand the basic principles about the banking industry, and then we are going to talk about the commercial banks, which are one of the largest financial institutions in the world. And we are going to move on to the rest of the depository institutions like mutual savings banks and credit cooperatives. First, let me begin with the basics of the banking. So, banking, this is an activity. This is a transaction between the financial institution and the consumers. And this originated in Italy in the age of Renaissance in about 14th century. At the time, in Italy, maybe the European students may know very much about this. At the time, there were city-states like Venice, Firenze, and Genoa, and they operated. They were prosperous through the commercial activities, and they were able to accumulate a lot of money, fortune, through the trade, international trade in the Mediterranean Sea. And as a result, we, the human beings, have experienced the birth of primitive banking. So during this international trades, so now you trade in Italy and you go to the Egypt and you trade and you come back and you sell it at France or somewhere else. So you need to take care of different coins and bills issued in different countries. So you need to store it, and at the same time you need to exchange it. And therefore there was a conceptual development about the banking industry. And at the same time, by providing these services, now these merchants were able to collect some fees about their services. So the term bank is known to be originated from the banco or banca, which meant bench, counter, or the desk of the money changers. And then, although the primitive banking was started in Italy, it was established in England. So one of the first modern banks was established in England in the 17th century. So at the time, the United Kingdom expanded their territories and colonies around the world, and they need to accumulate capital because they wanted to invest in some projects like developing so-called the New World. And there in London, the key concepts of banking was established. So let me explain how the goldsmiths turned into the bankers. They, at the beginning, they provided safe storage services, not the bankings as we think. However, later they found out that by doing the banking industry, they can be much more richer. So let me give you an example about a goldsmith at the time. So there is, suppose we have a goldsmith. Let's say, suppose you are a goldsmith and you received 10 pounds each from 10 customers. So you collect 100 pounds. And because now, at this moment, you don't have the concept of the banking. So what you can do is just store it. You can just provide the safe storage services. So you receive 100 pounds, and as you have done in your activity, you give the certificate of the deposits to your customers. And in your vault, you reserve 100 pounds. And that's the all what you can do at this moment. However, now soon, maybe 1 or 2 years later, starting your business, you realize that you can actually utilize the money that you have, because among the 10 customers, generally these customers do not come together. They come independently, and generally they rarely show up themselves. So therefore, you can start your business with the money. So you try to lend the money to someone else who requires the money right now. So what you do is that, like it is your own money, you start to give loans to some other customers. So you give 90 pounds and you give 10 pounds just in case that some depositors come back and try to withdraw their money. But that's okay, because generally those depositors will not come together. They are not going to move simultaneously. So everything works fine and you become more and profitable because you get some interest from the loans you make. But soon after that, the depositors realize that yourself is using your money like it is your own money. So they claim it and they want some of the shares that you make from this new business. So here there comes a concept called the fractional reserve banking, which is the modern banking system where you receive the deposits and you keep only a small portion of the money that you collect, and the rest of the money will be used in another business, which is lending. And then you need to distribute some of the profits to your original customers, the depositors. So therefore, you are going to give the deposit interest for the compensation, as a compensation for you using your safety. And then the difference between the loan interest rate and the deposit interest rate will be your profit. So here you receive, say, 6% deposits and you give 8% loans, and then approximately 2% will be your return. So by doing so, you can collect you can collect more depositors' funds because they are going to feel that if you plan to give more deposits, then they are going to store more funds, and using the larger funds of the money that you can make loans more and more, so you can be more profitable. And that's the modern banking, and that's the all. However, after the development of this modern banking system, now they started to define themselves as a new industry participants, and some of them turned into the central bankers. So let me talk about the central banks. So European students, you may know much about your own history, but after that, in 18th century, 19th century, and 20th century, we had a lot of wars. And when you fight with another country, you need money because you need to buy the weapons, you need to buy the fire powders, you need to hire your soldiers, right? So huge war expenditures occur during the age of imperialism and colonialism. And then, although the kings and the noble people are rich here, guys, but this is not sufficient even for them to take care of these huge war expenditures. So as a result, the monarchy started to ask the bankers for the money because they didn't have, but the bankers had. And then the banks cannot take it because it totally depends on the results of the war. So if the king wins the battle, then he can repay it by conquering the neighboring country. On the other hand, if the king is defeated, then the king will cut their head, and nobody will take care about your lending. So therefore, there is a large probability that this money will not be paid in full later. So they do not agree on the term, and then the kings ask for it once again. So there's a negotiation. So as a result of this negotiation, the central banks were founded. So the new agreement is following. First, banks will establish a new entity called the central bank, like the Bank of England. And then the Bank of England or the other central banks will fund the government by issuing new notes or the coins. In return, the government or the monarchy need to give a full authority, exclusive right to make new coins and the notes. So they are going to totally dependent on the central bank in terms of the finance. So it is beneficial for the both parties because the governments and the kings, they are happy because they can continue on their war expenditures. At the same time, bankers now get a full political power to control the overall economy. So both of the parties win. So as a result, now we have central banks. And you should remember that this is still the same in the modern days. So the central banks are not government bodies, but they are independent private institutions actually. So they can decide whatever they want, but they are in the partnership with the government usually. So that's why they have some consistency in their policy. But this may not be true because the origin of the banks started from the private bankers. Okay. And then the central banks is a association of the bankers. So they started to rule themselves, and they made a rule which is about the reserve requirement. So first, the reserve ratio is the ratio of the money that a bank reserves. So in the previous example, in this fractional reserve banking system, this is a typical one. So here the reserve ratio is 10% because they receive 100 deposits and they keep 10 pounds and the rest will be spent in the loans. So they only reserve 10%. So this is the reserve ratio that this bank has. Then if you set a lower reserve ratio, like 5%, that means you are going to lend 95 pounds to the others and you make more money. On the other hand, if you set a higher reserve ratio, that means you become more conservative and you keep the money inside and you do not make loans. So you become less profitable. That means there could be a tendency because the bankers are profit-seeking ones. So they seek profits and they are in the competition with other bankers. So it is very, very likely that they are going to set their reserve ratios as much as lower and they try to make loans as much as possible. And that means they are going to experience bankruptcy because they don't have the money actually. So when some depositors come back and ask for the money, they cannot pay it back. That means they are going to fail. And this is a crucial failure of the entire economy. So the bankers started to make a gentle agreement among themselves. So as a result, central bank make the reserve requirement system. And in this system, the central bank choose the minimum level of the reserve ratio that a bank can choose, and nobody cannot go further. So by doing so, they want to keep the entire economy to be safe. And then let's think about the consequences of this fractional reserve banking and the reserve requirement. First, banks will create credits. In other words, they are going to make loans. And for example, and then the very interesting thing is that money is a flow. So money is not staying in one position, but it moves from one person to another person and it goes on. So if someone borrows from a bank and if that person uses it, then it becomes another person's asset and it will be stored in that person's deposit account. And this process will be continued. So we have a sequential creation of the money. For example, bank number 1 can provide the funds to a businessman who wants to start a cafe business. And he will invest in an interior, so he will make his cafe much more beautiful. And then in this process, he may need to hire a new designer. And then he pays it. So the designer gets the money and she will deposit the money in her own bank. So the bank number 2 can have money. And it is not the end because bank number 2 can also make its own loan. So bank 2 lends to a merchant and this merchant buys the products from the farm. For example, the dairy products from a farmer, and the money will be transferred from the merchant to a farmer, and the farmer will store it in her own deposit, the bank number 3, and it goes on. So we have something like this. Number 1, originally there was only $100 bill in this economy, but in the bank one, in the bank, it reserve the 10% because the reserve ratio is 10% and make loans of $90. And the $90 flow freely in this economy, and eventually it will be deposited in the second bank's vault. And among the $90 that the bank number 2 gets, it keeps the 10%, which is $9, and use the rest, $81, to make loans. And it will also create the flow of the money in this economy, and eventually it will flow into the third bank. So the third bank starts with the $81 deposit, and it can reserve $8.1 reserve, and the rest will be used to make loans again. And it continues forever and forever. So this is a simple mathematics. Total money that this economy has from the initial $100 bill is some of these. First, it has the initial one, and the bank one can make $90 loans. Bank number 2 can have $81 loans. Bank number 3 can have $72.90 loans, and so on. Finally, if you add them up, mathematically, it will result in the total money supply of $1,000. So, banking system can multiply the money supply in the economy. So, for this reason, we can calculate the money multiplier, which is how much money will be supplied in the overall economy from a single dollar. And that is the reverse of the reserve ratio. So in the previous example, because we have the money multiplier of the 10%, the reverse of that 10%, 0.1, is 10 times, and that's the reason why, although we started with the $100, becomes $1,000 in this economy. Okay, so it makes a lot of money through the processes of the banks. And here comes the idea of the central bank's monetary policy. As I said, central banks is a association of the bankers, and they want to control the economy. So their roles in modern days is that the economy should be stable, not so hot or not so cold, somewhere between the middle. So they can try to make it much more smoother by choosing appropriate monetary policy. And one of the ways is to adjust the reserve ratio that I explained. So there can be two different directions. The first direction is an expansionary monetary policy in which the central bank is trying to increase the money supply. So what if you have abundant food? Then the value of food becomes lower. So it applies the same for the money. So if you have a lot of money, then the value of money decreases. So if the central bank increases money supply, what happens is that there will be first investment and consumption more than ever, because now people have a lot of money, so they want to spend it. So they invest, the corporations particularly, they invest in R&D, or they invest in patents, or they try to hire more people. And individuals or households try to consume more. At the same time, because the value of the money decreases, there will be inflation. So the prices of the products becomes higher. So you cannot buy the same product with the same money as before, but you need more money, extra money, to buy the same thing. But on the other hand, another direction is a contractional monetary policy in which the central banks try to cool down the economy. So they decrease the money supply. Then everyone will cut their budget because they don't have enough money. So they are going to shut down the factories. You are not going to buy luxury goods, so the prices are stabilized. However, it may lead to sometimes the negative aspects, like that your economy is so cold and everyone will be unhappy. So the central bank should wisely choose between two directions so that the economy is not so hot or not so cold. Then, as I said, one of the way is to utilize this reserve requirement system. So this is very simple. So let's say the central banks before the change, the reserve ratio, let me just write down RR, reserve ratio was 10%, but after the change, the reserve ratio becomes, say, 5%, and the money multiplier, let me denote MM, this will be 0.1, 1 over 0.1, so it is 10. However, in this new policy, the money multiplier is 1 over 0.05, so this is 20. So by lowering the reserve ratio from 10% to 5%, you can make, as a central bank, you can make 2 times larger amount of the money in the economy. So this is a typical expansionary policy. So it will be very likely that it will make the inflation. But on the other hand, if you set a higher reserve ratio, then this process is reversed. So it is actually getting the money back from the economy. So it is likely that the price will be stabilized. Another way is to set different interest rates. So the reserve changing the adjusting reserve ratio, it has been frequently used before, but now the central banks and policy makers started to realize that changing reserve ratio has a drawback. The drawback is that it can harm your economy, especially in the stability. As I said, the reserve ratio itself is significantly related to the probability of the bankruptcies. So therefore, if you set the bank's reserve ratio too low, that means banks are likely to go fail, and that will make a disaster in your economy. So nowadays, the central banks around the world do not change their reserve ratios frequently anymore. They just try to keep their reserve ratio for 10 years or 20 years or longer period. Instead, what they do is to change their interest rate set by the central bank. And it is also possible because if the central bank sets higher interest rate, the central bank's interest rate means the interest rate to the banks from the central bank to the bankers. And if it sets higher interest rate, the bank should follow it. It means the deposit interest rate will become higher, and the deposit interest rate will become higher. So everyone will enjoy higher interest rates if they store their money inside the bank. So many people will come to the banks and they are going to keep it in the bank. At the same time, for the loans, because loan interest rates become also higher. So as from the perspective of the corporations, you don't want it. You don't want to borrow from a bank because you need to pay larger compensation for the bank. So therefore, loans go down. And that means nobody tried to use the money, but everyone tried to store the money inside the bank. So the money flow in the economy decreases. So therefore, the price, the value of the money supply becomes smaller and the value of the money becomes higher. But on the other hand, if the central banks set a lower interest rate, then depositors will withdraw. They are going to become very, very angry because whatever they store in their bank's account, they get nothing. And the corporations, they try to make loans because they don't have to pay larger interest. So as a result, there's a lot of money flow, the money supply. So everyone there will be more investment and consumption. So this is actually what happened during the COVID-19. Every central banks around the world set the minimum interest rate like 0%. So deposit rates go down, the loan interest rate goes down, so nobody invests in the banking system. Everyone goes to the stock market, everyone goes to the cryptocurrencies like Bitcoin, and the prices become higher and higher. That is because the central banks made that choice. So this is the typical monetary policies that can control the overall economy's activities. Okay, so far I have discussed the development of the modern banking as well as the central bank's monetary policy, and then let's focus on the bankruptcy issues of the banks. So in 1933, far before you were born, in America, there was a Great Depression. So nowadays, we don't believe that the typical banks that we are having transactions will go bankruptcy. However, during the Great Depression, everyone rushed to the bank to withdraw their money before the bank claims the bankruptcy. So there's a long line waiting of people who try to withdraw their money. So this was able to be seen during your group activity. So some students as depositors chose to withdraw their money earlier than expected. And actually, this is not a historical one. So in 2 years ago, in 2023, even in the United States with a well-developed market, we have experienced a shutdown of a bank, which is a Silicon Valley Bank. So Silicon Valley Bank, as the name implies, it is in the Silicon Valley. And as you might know, Silicon Valley is the center of venture capitals. So there are a lot of startups and the venture companies. And Silicon Valley Bank is one of the financial institutions that support those startups. And eventually, they failed because for some reasons, depositors felt that this bank can go bankruptcy. So they just in a one day, they withdraw the all money from the bank. So banks were not able to pay it because they didn't have sufficient funds to cover everyone's funds because they are having loans for the corporations, as I said. So the bank failed. So this episode shows that the bank can fail even today. And let me explain how it happens. By the way, this single bankruptcy of a bank can lead to the sequential bankruptcies of other banks as well. And in that case, it will be called as the banking crisis. So the banking crisis, one of the fundamental reason why we have the banking crisis is that actually the banks can serve their customers in a first come first served basis. So in other words, if you are if you go to the bank earlier, then you will have a chance to recover your money. But if you are late, then everyone else already withdraw their money, so you don't get the money from the bank. So therefore, everyone rush to the bank. So that is called as sequential service constraint. So this is still the same even with the development of the mobile banking system, because you are going to use your mobile app, but it will be transferred to the bank system by the server. So if your request goes earlier, like 1 second earlier, you get what you want from the bank. But if you are late, then the server of the bank cannot serve you. So you will fail to get your money back from the bank. And it can be explained by the economic theory, so-called prisoner's dilemma. So let me explain about the prisoner's dilemma first. So let's say you and your friend decided to rob a shop, and you, with a gun, you visit a shop and you threat and you take the money from the shop and you run. And now the police will be following you, and for some unfortunate reasons you were caught and your friend is also caught. And now there will be an investigation by the police officers, but they are so wise that police officers separate you and your friend in different rooms, and they investigate each person separately. But they want your confession. So they ask whether you are going to confess and you are going to be guilty, but if you are cooperative, then you will get a lower punishment. So you can confess or you can stand mute. You keep your mouth shut up so to protect your friend. So like it is like the same as I did the whole thing, but my friend was just sitting here. He didn't do anything for your friendship. And the problem is that the police officer will do the same for your friend. So they will ask to your friend whether she would make the confession or not. And we have a 2x2 matrix of the results. If you stand mute, so you do not say anything, and if your friend also say nothing, then you will be in jail for just 1 year each. However, if you are in mute, however, if your friend confesses, then you will be blamed for everything and you will be in jail for 10 years. Or you can confess but your friend do not say nothing, then you can blame her and she will be in jail for 10 years, but you are free right now. But there's a possibility that both of you will confess. In that case, each of you will be in jail for 5 years. And if you can communicate with your friend, the best option is that you stand mute and your friend shut up. so that you are just going to be in jail for 1 year for each. However, because you are separated and you can't speak to each other, there's a problem. So that it is very likely, because you are worrying about the possibility that your friend will say something, you are going to confess. But this is also true for your friend. So your friend will also choose to confess. As a result, both of you will be in jail for 5 years, which is not a optimal solution for you. So this can be applied to the depositors. So we have two resulting cases. First, before that, let me explain about the dilemma of the depositors. So as a depositor, you can try to withdraw the money. In that case, there are two cases. Other depositors are not withdrawing, so they are keeping. Then you can withdraw the money easily because nobody is in the line. However, if you choose to keep the deposits, then what you get from the bank can be different depending on the choices of the others. If others are also keeping their deposits, everyone is safe because the banks do not need to give the money to the depositors. But on the other hand, if someone starts to withdraw, but you are just in your house, then maybe the bank will run out of the funds, and then you cannot get what you are promised. So that's the dilemma. And there are two results depending on the trust. First, if you trust the banking system, if you trust the bank's quality, and if you trust the others, then everyone will keep the deposits. So actually your banks become safe. But on the other hand, if there is no trust, then you are fearing about the possibility of the bank, so you should be in a hurry so that you are in the first line. And every others think the same, so they also run to the bank. As a result, the bank actually fails. So this is something that what you believe in will be realized. So if you believe that the banks will be safe, then actually the banks are safe. If you start to believe that the banks are not safe, then the banks are going to actually in the bankruptcy situation. So that's the typical depositor's dilemma and the problem or the vulnerability of the financial system. It totally depends on the trust among the people. So to avoid that situation where every banks go failure, the government has designed a special system to make everyone believe in the banking system, which is the deposit insurance system. So the deposit insurance system is a protection by the third party or the government that if you cannot get the money from the bank, I will give you the money instead. By doing so, you as a depositor, you don't have to rush to the bank, because if you just wait in your safe house, then the government agencies will help you. So everyone actually just stay in the line. Everyone just stay in their houses. So nobody rushes to the bank, and the banks are actually safer. So that's how the deposit insurance system works. And to do so, the governments need the money. So when everything looks fine, they prepare for some bad situations like what we have discussed. So what they do is that they collect a very, very small portion of the money from the bank, and they collect and they give it to a third party, such as the deposit insurance corporations. So in Korea, we have Korean Deposit Insurance Corporation, and in the United States, they have Federal Deposit Insurance Corporation. What they do is to collect some of the funds from the banks, and they keep it just in the case that the banks may fail. And if there is a actual possibility of the bankruptcy, then the Deposit Insurance Corporation comes out and they claim that they will take care about the deposits of this particular bank. And by doing so, depositors will feel that they are safe. Okay, so far I have described the landscape of the modern banking industry, and then let me talk about the players, the commercial banks. So a bank, or more precisely, a commercial bank, is the depository institution. So because this is a depository institution, it is also a lending institution. So it takes deposits and use the money to give loans. And especially the banks are chartered. So there is a famous bank named Standard Chartered Bank, SC Bank, which originated from the England. So chartered means this is authorized by their government. So the government gives some guarantee that this bank is safe, and it allows these particular financial institutions to engage in various kinds of activities that a bank can do. If a certain financial institution is not chartered or not authorized, it cannot take the deposit from the depositors because everyone will not believe in this bank. So chartered or authorization is important to become a bank. And the name, the commercial bank, the meaning is that generally the many of the loans will be spent on the industrial loans and the commercial loans. So what they usually do, their primary activity is to lend the money to the corporations. So in that sense, this is called as commercial bank, with to distinguish it from the investment bank that we are going to discuss in later chapters. And to be chartered by the government, the financial institution should have sufficient equity capital, so larger asset size, and sound financial position and social trust. So very interesting law in Korea is that if you are the CEO of a bank, and if you are guilty, then your bank will lose the authorization. So that makes a problem nowadays. So let me talk it later. And in Korea, we have two different major groups, nationwide banks and local banks. So the nationwide banks are the banks that have their operational system around the entire peninsula, and the local banks are those located in regional areas, and they operate generally in that area. And nowadays, we have 3 additional internet-only banks which do not have the physical branches, but they only use the apps, mobile apps, to provide their services. And this is a typical bank's balance sheet. And let's look at the asset. Among the total assets, what you can need to observe is that huge portion of the money will be invested in the form of the loans. So you have total loans of 9,000 million or something, and among the total loans, you can classify the loans depending on the purposes. So you have commercial and industrial loans, the loans given to the corporations, and the second, real estate loans, which is invested in housing market, and individual loans for some individuals' consumption, and also the banks also hold some securities like the bonds issued by the government. And in the liability side, you can see that among this huge amount of total liabilities and equity takes very small portion. So the most portion of the money comes from the depositors. So the total deposits are much larger. Okay, so that represents the two major activities of the banks. First, banks receive deposits from the individuals and use the money to make loans, particularly to the corporations. So the primary sources of the funding is the deposits, and there are two different kinds of deposits. First, demand deposits or transactional deposits. So these deposits are the money that depositors have the freedom to withdraw whenever they want. So the reason that we call them as demand deposit is because if depositors demand the money, the bank has an obligation to give the money immediately. On the other hand, some deposits are not demand deposits. So they are called non-transaction deposits, like savings deposit or the time deposits. And if you look at the asset side, there will be a assets that are existing for their profit. So the assets for their profits are called earning assets because they are making their earnings. And there are two categories, loans and securities. The loans are the primary ones. So you have commercial and industrial loans, real estate loans, and consumer loans or individual loans. And if you look at the securities, generally banks try to be much safer than other financial institutions. So in reality, most of the banks do not hold stock. They do not invest in the stock market, but they may engage in the bond market because bonds are safer than the stock. So, and also they try to avoid corporation bonds, so company bonds. So what they usually do is to buy the government bonds like U.S. Treasury or the bonds issued by the central banks. And this is a trend of the bank's assets from 1950s to present day. So you can find that the reason why they are called the commercial loans. So when their activities were at their peak in 1970s and 80s, when banks were most influential ones, the business loans took the number one place among the assets they had. Before that, they just usually invested in the U.S. government securities, but this is a premature period. But when they were in most activated situation, they invested a lot of money to the corporations. So there, now they get the name the commercial banks. But later, because of the development of the financial markets, like stock market, like Nasdaq, when New York Stock Exchange, they started to become the second place or the third place. So corporations had alternative funding sources, not the banks, but from other investors. So the business loans or the commercial loans become less profitable. And then their focus changed. They started to engage in the housing market. So you can see the mortgages. The mortgages are loans given to the house owners. If you have a house, if you intend to buy a house or an apartment in Korea, then you go to a bank. And using that apartment or the houses as a promise, you borrow the money from the bank. And so this is a real estate loan. And the portion of mortgages become higher and higher. And the trend continues until 2010, where the American experienced the global financial crisis. So after the global financial crisis, a lot of banks failed because they invested too much money on the housing market, and the trend become more stabilized or decentralized or diversified. Okay, and for the banks, we can classify their incomes into two categories. The incomes which are related to the interest receiving and giving, and second, and we have non-interest income, which is not related to the interest giving activities. So banks get their profits through making loans. So therefore, the primary portion of the interest income is the loan interest they receive from their assets. But on the other hand, banks may engage in other groups of activities, and in that case, if they make profits, then this will be called as non-interest rate income, because this is not related to the interest generating activities, but these are generally service fees and commissions. And to understand the activities that make the non-interest income, you need to understand the off-balance sheet activities. So as the name implies, off-balance sheet activities are not listed in the balance sheet. In the balance sheet, you can guess how much the bank has as loans and securities. They are on balance sheet activities. But some of the information, some of the services that the banks do are hidden from the balance sheet. First, we have loan commitment. The loan commitment is not yet a loan. This is a promise that eventually the bank will give loans to the party. So this is a promise that, so loan is an actual transactions, but before that, the bank and the corporation have an agreement, and in that case, this will be called as a loan commitment. So as a corporation manager, you can, if you feel that you are going to need some money in the future, you can have two choices. First, you can visit the bank today and you borrow, and then you are going to have loans from the bank right now. The second choice is that you make an agreement that in someday I want to borrow, and if I ask, you should give me the loan. That's the loan commitment. And the banks can provide this service to the corporations who think that in the future they are going to need some money, and by doing so, they are going to receive some service charges, upfront fees. And this is generally for the corporations, and the banks can have similar services to the individuals, the line of credit. So the line of credit is that similar to the so-called minus balance account for the Korean individuals. So in Korea, generally the depositors need to maintain a positive balance for their banking account. However, under the special circumstances, if you do not have the money, but you can still withdraw the money from the deposit account, and the balance will become negative one, and that's the typical line of credit. So it is a temporary borrowing from the bank, even if you do not have sufficient funds in your bank account. So these are the services that will be for the corporations and individuals who need the liquidity in the future. And by providing these services, the banks can charge higher fees and commissions. And the second item outside of the balance sheet is the letters of credit. This is related to the international trading. So let's say there is a company in Korea, company K, and there is a company F in France, and they engage in international trade. So company K produces some products and it delivers to the company F, and it sells the product in the France market. And you need to ship the products overseas, and you need to pay the prices to that company, right? So that's the international trade. But the problem is that there's a timing issue. So let's say the company K ships the products and it takes about 1 month. But yet company F didn't receive the product yet. Therefore, they cannot transfer the money as promised. So they need to check whether that shipment is accurate and whether the products are as they asked for. And they need to take care about it. If they just give the money, if they just transfer the money to the company K immediately, there's a possibility of the fraud, because they are in different countries, their communication is not clear. So they may have some problems. So company F wants to make sure that the shipments are delivered on time and with the same amount as promised, with the same quality as expected. So that's the problem. So here, banks can engage. So in the letter of credit system, first, company F, instead of transferring the money directly to company K, they give the money to their own bank in France. And because the banks in different countries still have their communication and trust, they can trust each other. And bank F will show the certificate that the company F had paid in full, and the bank K will confirm it to company K. And after confirmed, the company make shipments, and and it will be reported through the banks. And finally, when the shipments are delivered in France, the bank F will show up and check the shipments and say something about the quality. And if it is indeed as promised, then it will be transferred. So the money will be transferred to the Korean banking system, and finally, the money will be transferred to the company. So this is a we need some additional steps to make sure that the international trades are secured. However, by having these complicated steps, we can make sure that the exporting companies and importing companies get what they have wanted. The exporting companies get the money, and the importing company gets the products as promised. So this is the letters of credit, and through this process, these banks will also get some compensation, the fees and commissions. So these are the activities of the banks, and I will stop here and let me continue on Wednesdays.